There's a moment in history when everything looks perfect, when markets hit record highs, when everyone you know is making money, when experts on television tell you the economy has entered a new era where the old rules don't apply anymore. And then, without warning, the floor drops out. Not gradually, not with plenty of warning signs that everyone sees coming, but suddenly, violently, completely. This happened in 1929. The Roaring Twenties ended with the Great Depression. It happened in 2008. The housing boom ended with the financial crisis. And right now, in early 2025, we're standing in that exact same moment, the moment right before the crash. Every indicator that preceded the 1929 and 2008 crashes is present today. Not similar indicators. Not kind of close. Identical indicators. The same valuations. The same leverage. The same widespread belief that crashes are impossible because the system has evolved beyond them. And if the pattern holds, if history repeats the way it has twice before with mechanical precision, the crash will come in late 2026 or early 2027. Maybe sooner, maybe slightly later. But it's coming. This isn't speculation. This isn't fear-mongering. This is pattern recognition. And the pattern that preceded both 1929 and 2008 is playing out right now in real time. The pieces are in position. The leverage is at records. The complacency is total. And the people in charge, the Federal Reserve, the Treasury, the regulators, they've already used all their ammunition fighting the last crisis. They have nothing left in the chamber for the next one. What I'm about to show you is a documentary of a crash that hasn't happened yet, but follows a pattern that has happened twice before, with devastating accuracy. The mechanics are identical, the timeline is predictable, and the outcome, who gets destroyed and who gets rich, follows the same script every single time. If you understand the pattern, you can position yourself on the right side of the wealth transfer that's coming. If you ignore it, you'll learn the lesson the hard way, like millions did in 1929 and millions more did in 2008. Let me start with where we are right now. January 2025, the setup phase. Every crash begins with a bubble, and we are currently living through the largest everything bubble in financial history. Start with stocks. The S&P 500 is trading at valuations that have only been seen twice before. In 1929, right before the crash, and in 1999, right before the dot-com crash. The cyclically adjusted price-to-earnings ratio, the CAPE ratio, is above 35. The historical average is 17. At 35, stocks are more than double their normal valuation. You're paying twice what these companies are worth based on their earnings. Why would anyone pay double? Because everyone believes prices will keep rising. They believed the same thing in 1929. They believed it in 1999. They believed it in 2007. Every time the belief was wrong. But it's not just stocks that are in a bubble. Real estate is at all-time highs. The median home price in America right now is $420,000. The median household income is $75,000. That's a ratio of 5.6 to 1. You need 5.6 years of your entire household income just to buy a median-priced house. Historically, a sustainable ratio is about 3 to 1. That's what it was for decades. At 5.6 to 1, housing is overvalued by 87% relative to incomes. In 2006, right before the housing crash, the ratio peaked at 5.0. We're higher now. Housing is more expensive relative to incomes today than it was at the peak of the housing bubble that caused the 2008 crisis. Let that sink in. Corporate debt is at record levels. Non-financial corporate debt in the United States totals $13.5 trillion. That's 72% of GDP. In 2007, before the financial crisis, corporate debt was 43% of GDP. Corporations today are leveraged far beyond where they were before the last crisis. They borrowed trillions at low interest rates during the decade of near-zero rates from 2010 to 2021. Now those loans are maturing. They have to refinance. But interest rates aren't near zero anymore. They're at 5%. A corporation that borrowed at 3% now has to refinance at 7 or 8%. Many of them can't afford it. The debt service eats up all their profits. Some will default. When they default, the banks that lent to them take losses. And those losses cascade through the financial system. Government debt is $36 trillion, or that's 120% of GDP, higher than any time in American history except World War II. And we're not fighting a world war. We're running these deficits during peacetime, during an expansion. The interest payment on that debt is approaching $1 trillion per year. That's more than we spend on defense, more than Medicare. Just interest, not paying down the principal, just servicing the debt. And if interest rates stay elevated, which they have to unless the Fed wants to reignite inflation, those interest payments will rise to $1.5 trillion, maybe $2 trillion annually within a few years. That's unsustainable. Everyone knows it. But no one wants to talk about it. Consumer debt is over $17 trillion. Credit card debt at record highs. Auto loans at record highs. Student loans over $1.6 trillion, much of it never getting repaid. Consumers are leveraged to the maximum. They're spending more than they earn, financing the difference with debt. As long as the economy keeps growing and they keep their jobs, they can service the debt. But the moment the economy turns, the moment layoffs begin, millions of consumers will default on credit cards, auto loans, personal loans, and those defaults will hit banks. Add it all up. Government debt, corporate debt, household debt, financial sector debt. Total debt in the U.S. economy exceeds $90 trillion. That's over 320% of GDP. 3 times the size of the entire economy is debt. Every sector of the economy is leveraged beyond historical norms simultaneously. This is the everything bubble. Everything is expensive. Everyone is in debt. And everyone believes prices will keep rising forever because that's what's happened for 15 years. Why do people believe this? Why is there so much complacency? Because for 15 years since 2009, the Federal Reserve has guaranteed it. Every time markets started falling, every time there was a hint of crisis, the Fed stepped in. They cut interest rates. They printed money. Quantitative easing. QE1 in 2009. QE2 in 2010. QE3 in 2012. Operation Twist. Then COVID hit, and they printed $5 trillion in 2 years. Every time, the pattern was the same. Markets start falling. The Fed intervenes. Markets go back up. Investors learned a simple rule. Buy the dip. The Fed will save you. You cannot lose. This created what economists call moral hazard. When you remove the risk from risky behavior, people engage in more risky behavior. If you know the Fed will bail you out, why not leverage up? Why not borrow to buy stocks? Why not take maximum risk? There's no downside. The Fed has your back. But there's a problem. A massive problem that almost no one is talking about. The Fed has used its ammunition. In 2008, when the financial crisis hit, the Fed had tools. Interest rates were at 5%. They cut them to 0. That's 500 basis points of cuts. Huge stimulus. They also launched quantitative easing, buying bonds to inject money into the system. Their balance sheet went from $800 billion in 2008 to $4.5 trillion by 2015. Then COVID hit. They cut rates back to 0 again. They expanded the balance sheet to $9 trillion. They printed more money in 2 years than in the previous century combined. And it worked. The economy recovered. Markets went to all-time highs. But it also created inflation. By 2021, inflation hit 9%, the highest in 40 years. So the Fed had to fight it. They raised interest rates from 0% to 5.5% in 18 months, the fastest rate increase in 40 years. They also started shrinking their balance sheet, quantitative tightening. And it worked. Inflation came down to 3%, then to 2.5%. But the cost was enormous. Higher rates make existing debt more expensive. Every corporation, every consumer, every government entity that borrowed at low rates now faces much higher borrowing costs when they refinance. This is crushing. And the Fed is stuck. If they cut rates back to 0, inflation will return. If they keep rates high, the debt burden becomes unpayable. There's no good option. This is the critical difference between now and 2008. In 2008, the Fed had ammunition. They could cut rates 500 basis points. They could expand their balance sheet from $800 billion to $4 trillion. But today, Rates are already low by historical standards. The balance sheet is already at $7 trillion, down from $9 trillion, but still enormous. If another crisis hits, they can cut rates maybe 200 basis points before hitting zero. They can expand the balance sheet, but they're already holding trillions in bonds that are losing value because rates went up. If they buy more bonds, they'll take even bigger losses. And if they print more money, inflation will spike again. They're trapped. Rates too low, inflation returns. Rates too high, debt defaults cascade. There is no path that doesn't end in crisis. This is the setup. Maximum valuations across all asset classes. Maximum leverage across all sectors of the economy. A Federal Reserve that has already deployed its tools and has limited capacity to respond to the next crisis. And widespread belief that crashes can't happen because the Fed won't allow it. This is identical to 1929 and 2008. Identical. Let me show you the parallels because they're not approximate. They're exact. In 1929, the stock market had risen 400% from 1924 to 1929. 5 years of uninterrupted gains. Everyone was making money. Shoeshine boys were giving stock tips. Margin debt, borrowing money to buy stocks, reached 10% of GDP. People were leveraging everything to buy more stocks because stocks only go up. The phrase that defined the era was spoken by economist Irving Fisher just weeks before the crash. He said stock prices have reached what looks like a permanently high plateau. This wasn't some random commentator. This was one of the most respected economists in America saying crashes were impossible. The market had evolved. The Federal Reserve, which had been created in 1913, would prevent crashes. The new era had arrived. Then October came. October 24th, 1929. Black Thursday. The market fell 11% in one day. Panic selling. The next week was worse. October 29th, Black Tuesday. The market fell another 12%. Within 3 years, the market had fallen 89% from peak to trough. 89%. If you had $10,000 in 1929, you had $1,100 in 1932, and it didn't recover. The market didn't get back to 1929 levels until 1954, 25 years. An entire generation lost. In 2008, the pattern repeated. Housing prices had doubled from 2000 to 2006. Everyone was buying houses. No money down, subprime mortgages, ninja loans, no income, no job, no assets. Lenders didn't care because housing prices never fall. That's what everyone believed. Housing prices never fall nationally. It had never happened before. So the risk was zero. Mortgage debt reached 100% of GDP. The entire economy was levered into real estate. And Wall Street packaged all those mortgages into securities, CDOs, collateralized debt obligations, and sold them to investors worldwide. AAA rated, safe as treasuries, except they weren't. They were subprime garbage. But the ratings agencies, Moody's, S&P, Fitch, they gave them AAA ratings because they were paid by the banks creating the securities. It was fraud, but legal fraud. Then the defaults started. 2007, subprime borrowers who had bought houses they couldn't afford started missing payments. Foreclosures began. Housing prices started falling. And suddenly those AAA-rated securities were worthless. Bear Stearns collapsed in March 2008. Lehman Brothers collapsed in September 2008. The financial system froze. Credit markets stopped functioning. The stock market fell 57% in 6 months. The economy entered the worst recession since the Great Depression. Unemployment hit 10%. 8 million people lost their jobs. 10 million lost their homes. Both crashes followed the same pattern. Massive asset price appreciation, everyone making money, widespread belief that the boom is permanent, excessive leverage, then a trigger event, then cascading liquidation. And right now in 2025, we have the same pattern playing out. We have the asset price appreciation, stocks, real estate, everything at record highs. We have everyone making money. Everyone's 401k is up. Everyone's house is worth more. We have the belief that it's permanent. The Fed won't let markets crash. Crashes are a thing of the past. We have the excessive leverage, $90 trillion in total debt, 320% of GDP. All we're missing is the trigger. And there are multiple candidates. Let me walk through the 3 most likely triggers and how each one could ignite the cascade. Trigger 1. Commercial real estate collapse. This is the most likely because it's already happening in slow motion. Office buildings across America are 40 to 50% vacant. This isn't temporary. This is structural. COVID forced companies to experiment with remote work. And they discovered workers are just as productive at home, maybe more productive, so companies aren't bringing everyone back to the office. They're downsizing their office space. A company that used to lease 5 floors now leases 2. A company that leased 2 floors now leases 1. The savings are enormous. Why pay rent on empty space? So office buildings sit vacant, but those buildings were financed with mortgages. Billions in mortgages at low interest rates. A building purchased in 2019 might have a mortgage at 3.5%. That mortgage is maturing now. The owner has to refinance. But rates are 7%. A building that barely generated enough rental income to cover debt service at 3.5% is now bankrupt at 7%. The math doesn't work. Rental income of $10 million per year could cover a $200 million mortgage at 3.5%. But at 7%, that same $10 million in rental income can only support a $100 million mortgage. The building is worth half what it was. The owner is underwater. The economically rational decision is to default. Just walk away. Give the keys to the bank. Let them deal with it. And that's exactly what's happening. Brookfield Asset Management, one of the largest real estate companies in the world, defaulted on 2 Los Angeles office towers in 2023. They just stopped making payments, walked away. This isn't because Brookfield is in financial distress. They're enormously wealthy. They defaulted because those specific buildings are worth less than the mortgages. Why pay $300 million for a building that's only worth $150 million? You default strategically. This is called strategic default. And it's spreading. Over $2 trillion in commercial real estate mortgages mature between 2025 and 2027. If even 30% default, that's $600 billion in losses. Who holds those mortgages? Regional banks, small and mid-sized banks that specialize in commercial real estate lending. These banks have 20 to 40% of their loan portfolios in commercial real estate. When those loans default, the banks must recognize losses. Those losses eat through their capital. And when capital falls below regulatory minimums, regulators step in and close the bank. We've already seen this begin. Silicon Valley Bank failed in March 2023. Not because of commercial real estate, but because of interest rate risk and a bank run. But the underlying fragility is the same. Signature Bank failed the same week. First Republic failed in May 2023. 3 major bank failures in 2 months. The Fed and FDIC stepped in, arranged emergency sales, backstop deposits, crisis contained, or so they said. But the commercial real estate problem is getting worse, not better. If defaults cascade through 2025 and 2026, we could see 50 to 100 regional bank failures. Not just small community banks. Regional banks with tens of billions in assets. And bank failures create panic. When people hear their bank might fail, they withdraw their money. Bank runs. Even healthy banks can collapse in a bank run because banks don't keep enough cash on hand to pay all depositors at once. That's the nature of fractional reserve banking. They lend out 90% of deposits. If everyone wants their money back simultaneously, the bank fails. This is how contagion spreads. One bank fails. Depositors at other banks panic. They withdraw funds. More banks fail. The FDIC steps in, but the FDIC doesn't have unlimited resources. They have about $120 billion in their insurance fund. If $600 billion in commercial real estate loans default, if 50 banks fail, the FDIC fund gets depleted. Then Congress has to appropriate more money, bailouts. And while Congress debates, the panic spreads. This is trigger 1. Commercial real estate defaults leading to regional bank failures leading to systemic banking panic. Trigger 2. A major corporate bankruptcy or sovereign debt default. Hundreds of corporations borrowed billions at low rates from 2010 to 2021. Those loans are maturing now. They have to refinance at rates that are double or triple what they paid originally. Some cannot afford it. If their revenue is flat or declining, if their profit margins are thin, the increased interest expense pushes them into negative cash flow. They default. If a major corporation, a Fortune 500 company, a household name, defaults on its bonds, it sends shockwaves through the credit markets. Bond investors panic. If this company can default, who else might default? They start selling other corporate bonds. Prices fall, yields spike. And when yields spike, borrowing becomes impossible. Companies that need to refinance suddenly find no one willing to lend, so they default too. This is exactly what happened in 2008. Lehman Brothers failed, and immediately, everyone assumed other banks would fail. Washington Mutual failed. Wachovia almost failed. Credit markets froze completely. No one would lend to anyone. The commercial paper market, where corporations borrow short-term funds to meet payroll and operational expenses, it stopped functioning. Companies couldn't make payroll. The entire economy was days away from collapse. The Fed had to step in with emergency lending facilities, lending directly to corporations because banks wouldn't. The same thing could happen with corporate debt in 2026. One major default triggers questions about everyone else. Investors sell. Credit freezes. More defaults. The cascade accelerates. Sovereign debt default is similar but even more dangerous. Emerging markets hold trillions in dollar-denominated debt. Countries like Turkey, Argentina, Pakistan, Egypt, they borrowed dollars when rates were low and the dollar was weak. Now rates are high and the dollar is strong. Servicing those debts is crushing their economies. If one of them defaults, it triggers questions about all of them. Can any emerging market service dollar debt at these rates? Investors sell emerging market bonds. Capital flees these countries. Their currencies collapse, which makes the dollar debt even more expensive in local currency terms. More defaults follow. And here's the contagion path. Emerging market debt is held by European and American banks. If emerging markets default, those banks take losses. And if the losses are large enough, those banks fail. Suddenly, an emerging market problem becomes a developed market banking crisis. The interconnection of the global financial system means a crisis anywhere can spread everywhere. This is trigger 2. Corporate or sovereign defaults leading to credit market freeze, leading to systemic crisis. Trigger 3. A geopolitical shock, war, a pandemic, a terrorist attack, a contested election with violence, anything that spikes uncertainty and forces investors to liquidate assets to raise cash. The COVID crash in March 2020 was this type of event. COVID wasn't an economic problem initially. It was a health crisis. But the uncertainty about how bad it would get, how long lockdowns would last, whether companies could survive, that uncertainty forced investors to sell everything. When you don't know what's coming, you go to cash. The S&P fell 34% in 23 days, the fastest crash in history. Then the Fed stepped in with unlimited money printing, and it recovered. But the speed of the collapse showed how fragile the system is. If another shock of similar or greater magnitude occurs, the same thing will happen. A major war, China invades Taiwan, the US and China in direct military conflict. Oil prices spike, supply chains collapse, markets crash, or conflict in the Middle East. Iran closes the Strait of Hormuz. 20% of global oil supply flows through that strait. If it's closed, oil prices triple, inflation spikes, the economy enters recession, markets crash, or a contested US election. The 2024 election ends with both sides claiming victory. Violence, political crisis, constitutional crisis. Markets hate uncertainty. They crash. Any of these scenarios, or something we're not even thinking about, could be the trigger. But here's the key. The trigger doesn't matter. The trigger is just the spark. The real problem is the kindling, the $90 trillion in debt, the extreme valuations, the leverage. The system is ready to burn. Any spark will do. Any. Once the crash begins, it follows a predictable pattern, not the exact same timeline. 1929 took 3 years to reach bottom. 2008 took 6 months. 2026 could be anywhere in between. But the sequence, the stages, those are always the same. Let me walk through them. Phase 1. The initial shock. The trigger event happens. Markets fall 10 to 15% in a matter of days, maybe a week. It's sharp and violent, but it's not the real crash yet. Investors are surprised but not panicked. This is seen as a buying opportunity. Buy the dip. Everyone's been trained for 15 years that dips get bought. The Fed will step in. Stocks are on sale. Media brings on analysts who say the fundamentals are strong. This is temporary. Corporate earnings are solid. Employment is strong. This is just a healthy correction. In 1929, the initial shock was October 24th, Black Thursday. The market fell 11% in one day. There was panic, but prominent bankers met that evening and pledged to support the market. They bought stocks the next day. Prices stabilized. The worst seemed over. In 2008, the initial shock was March 2008, when Bear Stearns collapsed. The market fell 15% from the peak, but the Fed arranged for J.P. Morgan to buy Bear Stearns. They provided financing. Crisis averted. The market recovered through spring and summer. Everyone thought the bottom was in. In 2026, the initial shock could be a major bank failure, or several bank failures in 1 week, or a Fortune 500 company bankruptcy. Markets fall 10 to 15%. The Fed issues a statement. We are monitoring the situation closely. The financial system is sound. We stand ready to provide liquidity. The Treasury says the same thing. Congress holds hearings. And investors, trained to buy the dip, start buying. Stocks recover partially. Maybe they get back half of what they lost. This is the most dangerous phase. Phase 2. The false recovery. After the initial shock, markets stabilize. They might even rise back near the previous highs. This lasts weeks or months, and it's incredibly dangerous because it convinces people the worst is over. In 1929, after Black Thursday, the market recovered for a week. By early November, stocks were nearly back to where they were before the crash. Investors who had sold felt foolish. They'd locked in losses for nothing. Investors who bought the dip felt vindicated. They'd made money. See, it was just a correction. But then, November 11th arrived. The market fell 13% in one day. Then it kept falling, day after day. The real crash had begun. And it didn't stop until July 1932, 3 years later, when the market had lost 89% of its value. In 2008, after Bear Stearns collapsed in March, the market stabilized through spring and summer. By July 2008, the S&P was only down 10% from its October 2007 peak. Many analysts called the bottom. The crisis is contained. The subprime problem is limited to a few bad lenders. The rest of the economy is fine. Housing has stabilized. Then September came. Lehman Brothers declared bankruptcy on September 15, 2008, the largest bankruptcy in American history. The government didn't bail them out. They let them fail. And the markets realized if Lehman could fail, anyone could fail. The S&P fell 40% in 6 weeks, the fastest collapse outside of 1929. Banks stopped lending. Credit markets froze. The global financial system was days away from complete collapse. In 2026, the false recovery could last 3 to 6 months. The initial bank failure or corporate default is blamed on mismanagement. Specific incompetence. It's not systemic. The regulators say the bank was poorly run. The corporation made bad decisions. But the rest of the financial system is sound. The Fed cuts interest rates modestly, maybe 50 basis points. Congress passes a small stimulus package. Markets rally. The S&P recovers most of what it lost. Maybe it even makes a new high. Investors who sold during the initial shock kick themselves. They missed the rally. Investors who stayed in or bought the dip feel brilliant. They knew it was just a correction. But beneath the surface, the problems are spreading. More commercial real estate loans are defaulting. More banks are seeing their capital erode. More corporations are struggling to refinance debt. The defaults are accelerating, but they're not making headlines yet, not individually. But the cumulative effect is building, and then something breaks. Another bank fails, a bigger bank, or 3 banks fail in 1 week. Or a major corporation, a company everyone knows, defaults on billions in bonds. And suddenly the market realizes this isn't contained. This is systemic. And that's when Phase 3 begins. Phase 3. The cascade. This is the real crash. The phase where forced liquidation creates more forced liquidation, where panic feeds on itself, where the system breaks. In 1929, the cascade lasted from November 1929 to July 1932. 3 years of grinding decline. 89% total loss. In 2008, the cascade was compressed. September 2008 to March 2009. 6 months. 57% loss. The 2026 cascade will probably be somewhere in between. 12 to 18 months. A 50 to 70% decline from peak to trough. Maybe worse if the government response is slow or ineffective. Let me show you exactly how the cascade works mechanically. Stage 1 of the cascade. Margin calls. Investors who borrowed money to buy stocks, margin debt, get margin calls when stocks fall. If you bought $100,000 of stock with $50,000 of your own money and $50,000 borrowed from your broker, you're leveraged 2 to 1. If the stock falls 20%, your $100,000 becomes $80,000. You still owe your broker $50,000. So your equity is only $30,000. You've lost 40% of your money even though the stock only fell 20%. That's leverage, and your broker sees this and issues a margin call. Deposit more cash or we'll sell your stock. Most people don't have more cash to deposit, so the broker sells. Forced selling. And when millions of leveraged investors are getting margin calls simultaneously, that's millions of shares being sold regardless of price. This drives prices lower, which triggers more margin calls, which creates more forced selling. A liquidation spiral. Stage 2. Institutional redemptions. Mutual funds, hedge funds, pension funds. When their assets fall, investors want out. They redeem their shares. They want their money back, and funds must sell stocks to raise cash to pay redemptions, even if they don't want to sell. Even if they think stocks are cheap, they have no choice. Redemptions must be met. So they sell. And when thousands of funds are all selling simultaneously, prices collapse. Stage 3. Algorithmic amplification. High-frequency trading algorithms dominate modern markets. They execute trades in microseconds based on price movements and patterns. When they detect a downtrend, they sell. Stop-loss orders trigger automatically. When the S&P falls 5%, algorithms programmed to sell at that level execute. This creates a cascade of automatic selling that has nothing to do with fundamentals or human decision-making. It's just code executing. Circuit breakers halt trading when markets fall too fast. But when trading resumes, the selling continues. The halt just compresses the panic into a shorter time frame. Stage 3. Liquidity vanishes. This is the most dangerous stage. When everyone wants to sell and no one wants to buy, there are no bids. You can't sell your stock at any reasonable price. Stocks gap down 10, 20, 30% because there's no buyer. Market makers, the firms that are supposed to provide liquidity, step back. They're not going to catch a falling knife. They wait until the panic subsides. But while they wait, liquidity disappears. The market isn't declining smoothly. It's collapsing in free fall. Stage 5. Credit freeze. This is when the crash moves from markets to the economy. When stock prices are collapsing and financial institutions are taking losses, banks stop lending. Why would you lend money when your borrower might be bankrupt next month? You don't. Credit freezes. And when credit freezes, the economy stops. Companies need credit to make payroll, to buy inventory, to fund operations. When they can't get credit, they lay off workers, they cut production, they default on existing loans. This creates a feedback loop. Layoffs reduce consumer spending. Reduced spending hurts corporate revenue. Lower revenue leads to more layoffs. The stock market crash becomes an economic recession. Unemployment rises from 4% to 8%, then 10%. Millions lose their jobs. They stop paying mortgages, credit cards, auto loans. Those defaults hit banks. Banks take more losses. Some fail. The cycle accelerates. This is the cascade. And once it begins, it's very difficult to stop. Phase 4. Maximum panic. This is the bottom. The point of maximum fear when people are selling everything regardless of price. When headlines scream about the end of capitalism. When unemployment is 10% and people genuinely believe the financial system might collapse completely. In 1929, the panic bottom was July 1932. The Dow at 41, down 89% from the peak. Unemployment at 25%, banks failing by the hundreds. Every week more banks closed. People's life savings disappeared overnight. In 2008, the panic bottom was March 2009, the S&P at 666, down 57%. Unemployment at 10%. General Motors bankrupt. Chrysler bankrupt. Major banks like Bank of America and Citigroup insolvent, only surviving because of government bailouts. In 2026 or 2027, the panic bottom will look similar. The S&P, currently around 6,000, could fall to 2,000 or lower. 60 to 70% decline. Unemployment at 10% or higher. Multiple bank failures. Major corporations bankrupt. And the government stepping in with emergency measures. This is the moment when fortunes are made. The moment when those who held cash through the crash deploy it. When the maximum fear creates maximum opportunity. But you have to have the cash. And you have to have the courage to buy when everything feels hopeless. In March 2009, it felt like the world was ending. Buying stocks felt insane. But those who did, who bought at the bottom, made generational wealth. The S&P tripled from the 2009 bottom to 2013. If you'd invested $100,000 at the bottom, you'd have $300,000 4 years later. And $500,000 by 2017, and over $1 million by 2024. Phase 5. The slow recovery. The crash ends when the government intervenes massively. In 1933, Franklin Roosevelt launched the New Deal. Massive public works programs, jobs programs, banking reform, deposit insurance, restoring confidence in the financial system. It worked, but slowly. The economy recovered through the 1930s, but stocks didn't reach 1929 levels again until 1954, 25 years later. In 2008, the government's response was faster and more aggressive. The Fed cut rates to zero. They launched quantitative easing, printing $3 trillion. Congress passed an $800 billion stimulus. They bailed out the banks, the auto companies, the insurance companies, trillions in bailouts and stimulus. And it worked. The economy recovered. Stocks reached new highs by 2013, just 4 years after the bottom. In 2026 and 2027, the government will respond again. The Fed will cut rates to zero, probably below zero if they can figure out how. They'll launch another round of quantitative easing, probably larger than 2008. 5 trillion, maybe 10 trillion. Congress will pass stimulus packages, trillions in spending, and there will be bailouts. Banks will be bailed out. Maybe airlines, maybe retailers. Anyone big enough and politically connected enough will get bailed out. But the recovery will be slower than 2008 for one reason. Debt. Government debt is already 120% of GDP. Adding trillions more in stimulus pushes it to 150%, maybe 180%. At those levels, the interest payments consume so much of the budget that other spending must be cut, or taxes must be raised, or the debt must be inflated away. None of those options are politically popular. And the economic recovery, getting unemployment back down, getting growth back to normal, that could take 5 to 10 years. Stocks might not reach 2025 levels again until 2032 or later. This is the 5-phase pattern. Initial shock, false recovery, cascade, panic bottom, slow recovery. It's happened twice before exactly this way, and it's about to happen again. Now let me show you who gets destroyed and who profits, because every crash creates a massive wealth transfer, from those who don't see it coming to those who do, from those who are fully invested and leveraged to those who hold cash and hard assets. Who gets destroyed? The middle class, again. In 1929, middle-class families who invested their savings in stocks lost everything. People who felt wealthy in 1928 were destitute by 1933. Their stock portfolios fell 89%. Their homes were foreclosed when they couldn't make mortgage payments because they'd lost their jobs. An entire generation's wealth was wiped out. In 2008, middle-class homeowners who bought at the peak lost 30 to 50% of their home equity. Many went underwater, owing more on their mortgage than the house was worth. Millions were foreclosed. Millions more walked away strategically. And those who held on watched their largest asset lose half its value. In 2026, It happens again. Middle-class families with 401k retirement accounts will watch them fall 50 to 70%. A $500,000 retirement account, built over 30 years of saving, becomes $200,000. Gone. And if you're close to retirement, you don't have time to wait for the recovery. You might have to work another decade. Homeowners who bought in the last few years at peak prices will see their home values fall 30 to 50%. A $600,000 house becomes $400,000. If you put down $100,000, your equity is gone. You're underwater. Retirees are devastated. If you're 65 years old in 2026 with $800,000 saved for retirement, planning to live on 4% withdrawals, that's $32,000 per year. But if your account falls to $300,000, your withdrawals drop to $12,000. You can't live on that. You have to go back to work. Small business owners go bankrupt. When consumers stop spending because they're worried about losing their jobs, businesses lose revenue. They can't pay rent, can't pay employees. They close. In 2008, over 170,000 small businesses failed. In 2026, the number could be higher because small business debt levels are higher now. Restaurants, retail stores, service businesses, gone. And the owners, they don't just lose their business. They often lose their house because they used it as collateral for business loans. Bankruptcy, destroyed credit, a decade or more to recover financially. Leveraged investors are completely wiped out. Anyone who borrowed to invest, whether margin debt to buy stocks or mortgages to buy rental properties, they face margin calls and forced liquidation at the worst possible prices. They don't just lose their investment. They lose more than they invested because they're in debt. And in a bankruptcy, that debt doesn't disappear. It follows them. Now, who profits? This is the important part. The part most people don't understand. Every crash makes someone extraordinarily wealthy. In 1929, Joseph Kennedy, the patriarch of the Kennedy family, made tens of millions by selling his stocks before the crash and then shorting during the decline. He reportedly made $50 million, equivalent to hundreds of millions today. Bernard Baruch, a financier and advisor to presidents, held cash and gold through the crash, then bought assets at depression prices: real estate, businesses, stocks. He emerged from the depression wealthier than he entered it. In 2008, John Paulson made $20 billion betting against subprime mortgages. He saw the housing bubble, structured trades that would pay off when mortgages defaulted, and made one of the largest personal fortunes in history in a single year. Michael Burry, depicted in The Big Short, made $700 million with the same trade. Kyle Bass made hundreds of millions. And Warren Buffett, he made billions buying Goldman Sachs and Bank of America during the crisis, when their stock prices had crashed, and everyone thought they might fail. He negotiated sweetheart deals, preferred shares that paid 10% dividends. And he made billions as those banks recovered. In 2026, the same playbook will create the next generation of billionaires. Who profits? Cash holders. The most important thing, the investors who sell stocks before the crash and hold cash or short-term treasury bills. Cash doesn't fall when stocks fall. It actually gains purchasing power. If you have $1 million in cash and stocks fall 60%, your purchasing power relative to stocks has increased 2.5 times. You can now buy what used to cost $2.5 million for $1 million. Then, at the panic bottom when everyone else is selling in terror, you deploy. You buy stocks at 40 cents on the dollar. You buy real estate at foreclosure auctions for 50% of peak value. You buy businesses that are being liquidated. Warren Buffett currently holds $325 billion in cash in Berkshire Hathaway's treasury. He's been building that cash pile for years, selling stocks, not buying. Why? Because he's waiting. When the crash comes, he'll deploy that cash. He'll make the same investments he made in 2008, except the scale will be larger. He could make $50 billion or $100 billion in the next crash. The greatest wealth accumulation of his career is still ahead of him at age 95. Short sellers profit enormously. Investors who bet against overvalued stocks or vulnerable sectors make money as prices fall. In 2026, the obvious shorts are commercial real estate, regional banks, over-leveraged corporations. If you short a bank stock at $50 and it falls to $5, you make $45 per share. Hedge funds that are building these positions now, quietly shorting without announcing it, they will make billions. The exact same trade Paulson and Burry made in 2008, just in different sectors. Gold holders profit. In 2008, gold was at $800 per ounce. By 2011, it reached $1,900, a 137% gain while stocks were barely recovering. In the next crash, gold will do the same thing. Right now, gold is around $2,700 per ounce. When the crash comes and the Fed responds by printing trillions in stimulus, gold could go to $5,000 or $6,000 per ounce, maybe higher if inflation returns. Gold is the ultimate safe haven. It can't be printed, it can't be debased. It holds value when currencies are being destroyed. Distressed debt buyers make fortunes. When companies go bankrupt, their bonds trade at 10 to 30 cents on the dollar. Vulture funds, specialists in distressed debt, buy these bonds for pennies. Then, when the company restructures in bankruptcy, those bonds often convert to equity in the new company. A $100 million investment in distressed bonds can become $300 million or $500 million in equity. Carl Icahn, Howard Marks, and Oaktree Capital, they all made fortunes doing this in 2008 and 2009. They'll do it again in 2026 and 2027. Real estate investors with cash profit massively. When foreclosures spike, properties sell at auction for 40 to 60% of peak values. Investors with cash buy entire portfolios, hundreds or thousands of homes. They rent them out and wait. When the economy recovers, those homes appreciate back to normal values. Blackstone did exactly this from 2009 to 2012. They bought 80,000 single-family homes at crashed prices, rented them out, then sold many of them years later at huge profits. They made billions. And they'll do it again. Private equity firms profit enormously. These firms have raised over $2 trillion in what's called dry powder, capital that's been raised from investors but not yet deployed. They're sitting on cash waiting for opportunities. When the crash comes, they'll buy companies being liquidated. They'll buy divisions of large corporations that need to raise cash. They'll buy assets at 30 to 50 cents on the dollar. Hold them for 5 to 7 years while the recovery happens, then sell at full price or take them public. This is how private equity firms create generational wealth. Not by operating businesses better, though they do some of that, but by buying low during crashes and selling high during recoveries. They need crashes. Crashes are when fortunes are made in private equity. The wealth transfer is enormous. In 2008, approximately $10 trillion in wealth was destroyed from the peak to the trough of the stock market. But that wealth didn't evaporate. It transferred. From middle-class 401k holders who sold at the bottom to cash holders who bought at the bottom. From homeowners who were foreclosed to investors who bought those homes at auction. From companies that went bankrupt to the distressed debt funds that bought their bonds for pennies. Wealth isn't destroyed in crashes. It's transferred. From the unprepared to the prepared. From the leveraged to the liquid. From those who believed the bubble would last forever to those who saw the crash coming. And the 2026 crash will create the largest wealth transfer in history because the scale is larger. If $30 trillion in market value is lost, that's $30 trillion transferring from those who hold through the crash to those who position correctly. This is not theft. This is not illegal. This is understanding cycles, understanding that crashes are not aberrations. They're features of the system. They happen with predictable regularity when conditions align. And right now the conditions are aligned. The setup is complete. The only thing missing is the trigger. And the trigger will come. It always does. Let me compare the 2026 crash directly to 1929 and 2008. What's the same? What's different? The similarities are striking. The bubble mechanics are identical. In all three cases, asset prices became disconnected from fundamentals. 1929, stocks at 30 times earnings when the normal ratio is 15. 2008, homes at 5 times incomes when the normal ratio is 3. 2026, everything at record valuations simultaneously. Stocks, real estate, corporate bonds, all overvalued at the same time. The leverage is the same. In 1929, margin debt at 10% of GDP. In 2008, mortgage debt at 100% of GDP. In 2026, total debt across all sectors at 320% of GDP, the highest in history. The belief is the same. Every bubble believes this time is different. In 1929, They said permanently high plateau. The Fed will prevent crashes. In 2008, they said housing prices never fall nationally. Subprime is contained. In 2026, they say the Fed has infinite tools. Crashes can't happen because policymakers learned from the past. Every bubble tells itself the same lie. We're different. The old rules don't apply. None were different. None are. The cascade mechanics are the same. Forced liquidation triggers more forced liquidation. Margin calls, redemptions, algorithmic selling, credit freeze. These are mechanical processes, not emotional. Once leverage reaches critical levels and a trigger appears, the cascade is automatic. The wealth transfer is the same. Those with cash, gold, and short positions profit. Those fully invested, leveraged, and unprepared are destroyed. This pattern is universal across crashes. But there are differences. The scale is unprecedented. In 1929, U.S. stock market capitalization was roughly $80 billion at the peak. In 2008, it was $12 trillion. In 2026, it's $50 trillion. The scale is 4 times larger than 2008. If the market falls 60%, that's $30 trillion in losses, 4 times the 2008 crash. The speed could be faster. 1929 took 3 years to reach bottom. 2008 took 6 months. 2026 could be even faster. Algorithmic trading, global interconnection, instant information flow. Everything moves faster now. The initial cascade could happen in weeks instead of months. Flash crashes that last days. Circuit breakers tripping daily. The entire crash could be compressed into 3 to 6 months. The global interconnection is total. In 1929, the crash was primarily American. It spread to Europe over time, but slowly. In 2008, it was global, but emerging markets like China recovered quickly through massive stimulus. In 2026, it will be truly global and simultaneous. China, Europe, Japan, emerging markets, all interconnected through trade, finance, currency markets. A crash in one region spreads instantly to all others. There is no decoupling. There is no safe haven geographically. The government's capacity to respond is limited. This is the most important difference. In 1929, the government did almost nothing initially. No Fed intervention, no stimulus, no bailouts. That's why it took so long to recover. In 2008, the government had tools. Interest rates at 5%, they cut to 0. Balance sheet at $800 billion, they expanded to $4 trillion, fiscal space to spend $800 billion in stimulus. And it worked. In 2026, rates are already low. The balance sheet is already $7 trillion. Government debt is already 120% of GDP. The Fed can cut maybe 200 basis points before hitting 0. They can expand the balance sheet, but how much? Another $5 trillion, that would put it at $12 trillion. At some point, expanding the balance sheet just creates inflation without helping the real economy. And fiscal stimulus, Congress can pass another multi-trillion-dollar package, but that pushes government debt to 150% or 180% of GDP. At those levels, the interest payments consume so much of the budget that other spending must be cut or taxes must be raised dramatically. The political will might not exist, or the response might be delayed while Congress argues, and delays make crashes worse. The social and political consequences could be severe, more severe than previous crashes. In 1929, the crash led to political extremism, the rise of fascism in Europe, communism gaining support, political instability. In 2008, it created the Tea Party movement, Occupy Wall Street, political polarization that still defines American politics. In 2026, the consequences could be worse because the preconditions are worse. Wealth inequality is higher now than in 1929. The top 1% control 32% of wealth. The bottom 50% control 2%. The middle class has been hollowed out. If the crash destroys the remaining middle class wealth, if millions lose their homes, their retirement savings, their jobs, the political backlash will be enormous. Populism, extremism, maybe violence. When people lose everything, when they see billionaires profit while they're destroyed, they get angry. And angry populations do unpredictable things. They elect extremists. They demand radical change. They sometimes revolt. This isn't hyperbole. This is historical pattern. The Great Depression led directly to World War II, not because the Depression caused the war, but because the economic devastation created political instability that extremists exploited. A 2026 crash that destroys the middle class could lead to political instability in America that we haven't seen since the Civil War. That sounds extreme. But the pattern says economic crashes that destroy the middle class create political instability. And we're more polarized now than we've been in 160 years. Let me give you the timeline. Not exact dates, those are impossible to predict. But the pattern-based sequence of how this will likely unfold. Early 2025, right now. We're in the setup phase. Markets at all-time highs. Valuations extreme. Leverage at records. Complacency total. Investors believe the Fed will prevent crashes. This is the calm before the storm. Mid-2025 to early 2026, the trigger event. Something breaks. A wave of bank failures. A major corporate bankruptcy. A sovereign default. A geopolitical shock. Markets fall 10 to 15%. Phase 1, the initial shock. The Fed responds with a statement. Treasury responds. Investors buy the dip. Spring 2026, the false recovery. Markets stabilize, maybe even rally back near previous highs. The media declares the crisis over. Analysts say fundamentals are strong. Investors who sold feel foolish. Those who bought feel vindicated. But beneath the surface, defaults are spreading. Commercial real estate, corporate debt, banks, summer to fall. 2026, the cascade begins. The real crash. Another trigger, probably larger than the first. Markets enter freefall. 50% decline over 6 to 9 months. Credit markets freeze. The economy enters recession. Unemployment spikes. Late 2026 to mid-2027 panic bottom. Maximum fear. Markets down 60 to 70%. Unemployment at 10%. Multiple bank failures. Major corporations bankrupt. Government announces emergency measures. Fed cuts to zero. Congress passes multi-trillion-dollar stimulus. This is the bottom, the moment of maximum opportunity for those with cash. Late 2027 to 2030, the recovery. Markets stabilize, then begin climbing. Slowly. The economy recovers gradually. Unemployment falls. But it takes years. Stocks might not reach 2025 levels again until 2030 or later. The recovery is slower than 2008 because the debt levels are higher and the government's capacity to respond is limited. This timeline could compress or extend by months, but the sequence is locked. The pattern is repeating. We are in the setup phase now. The trigger will come, probably within the next 12 to 18 months. The cascade will follow. The panic bottom will arrive. And then the slow recovery. This is not prediction. This is pattern recognition. The same pattern that played out in 1929 and 2008 is playing out now. And if you understand the pattern, you can position yourself on the right side of the wealth transfer. So what should you do? I'm not a financial advisor. This is not financial advice. But pattern recognition and historical analysis suggest several strategies. First, reduce stock exposure. If you're 100% invested in stocks right now, you're maximally exposed to the crash. Consider reducing to 50 or 60% stocks, holding the rest in cash or short-term treasury bills. You'll miss some gains if markets continue higher in the short term. But you'll preserve capital when the crash comes, and preserved capital is what lets you buy at the bottom. Second, accumulate gold. 5 to 10% of your portfolio in physical gold or gold ETFs. When the crash comes and the Fed prints trillions in response, gold will surge. It did in 2008 to 2011, rising 137%. It will do it again. Third, hold cash, real cash. Money market funds, treasury bills, FDIC-insured savings. Not checking accounts at regional banks that might fail. You want to preserve purchasing power through the crash so you can deploy at the bottom. Buffett holds $325 billion in cash. He's not stupid. He's waiting. Make a list of quality companies you want to own. Blue-chip companies with strong balance sheets, low debt, recession-resistant businesses, Apple, Microsoft, Visa, Johnson & Johnson, Berkshire Hathaway. Make your list now. Then when the crash comes, when these stocks fall 50 or 60%, you buy. You'll know exactly what to buy because you made the list when you were thinking clearly. Fifth, prepare psychologically. This is harder than it sounds. When the crash comes, when the S&P is down 50%, when unemployment is 10%, when media is screaming about financial collapse, buying stocks will feel insane. It will feel like catching a falling knife. Your instinct will be to sell, not buy. You have to prepare for this now. Understand that maximum fear is maximum opportunity. In March 2009, buying stocks felt like financial suicide. But those who did made fortunes. You need the psychological preparation to act when it feels impossible. Sixth, protect your income. If mass layoffs are coming, make yourself valuable at work. Reduce personal debt so if you lose your job, you can survive on savings. Build an emergency fund that covers 6 months of expenses. Having cash reserves means you don't have to sell investments at the bottom to pay bills. You can hold and wait for the recovery. Watch the indicators. I can't tell you the exact day the crash starts, but there are indicators that will signal when the cascade is beginning. Watch commercial real estate default rates, watch regional bank stock prices, watch high-yield corporate bond spreads. When these indicators start deteriorating rapidly, it means the trigger is here. When you see these signals, that's when you get defensive. Move to cash. Reduce exposure. Protect capital. The 2026 crash is not certain. It's possible, maybe even likely based on the pattern, but not guaranteed. It's possible the Fed engineers a soft landing, that valuations normalize gradually without a crash, that leverage unwinds slowly, that we avoid catastrophe. But the pattern says otherwise. Twice before, when conditions aligned like they are now, crashes followed. Devastating crashes that destroyed the unprepared and enriched those who saw them coming. The setup is complete. The bubble is inflated. The leverage is at records. The belief in permanence is universal. And the government has limited ammunition left to fight the next crisis. We're waiting for the trigger. And when it comes, the pattern says we're in for the largest wealth transfer in human history. From those who are fully invested and leveraged to those who are liquid and prepared. If this documentary showed you a pattern you'd never seen before, if you understand now why late 2026 or early 2027 could be the moment everything changes, you have a choice. You can ignore the pattern and hope this time is different. Or you can recognize the pattern and position accordingly. The pattern doesn't guarantee the crash, but the pattern has been right twice before. In 1929, those who saw it coming and sold their stocks before the crash preserved their wealth, while everyone else was destroyed. In 2008, those who saw the housing bubble and positioned accordingly made billions, while the middle class lost trillions. In 2026, the same thing will happen. The pattern will repeat. The cascade will unfold. The wealth will transfer. The only question is which side you'll be on. Will you be the one who loses half your retirement account? Or will you be the one who holds cash through the crash and deploys it at the bottom? Will you be foreclosed on? Or will you be buying foreclosed properties at auction? Will you panic sell at the bottom? Or will you have the cash and courage to buy? The choice is yours. But the pattern is clear. The Great Depression, the financial crisis, and coming soon, the 2026 crash. 3 times. Same pattern, same sequence, same outcome. Those who see it coming survive and profit. Those who ignore it learn the hardest lesson in finance. Crashes don't destroy wealth, they transfer it. Make sure you're on the receiving end.